Hello traders, welcome back. In today's video, we are diving deep into an essential liquidity concept, which is high resistance liquidity and low resistance liquidity. This concept will help you decode how market flows, why certain price level acts as magnet for price action. So whether you are a beginner or an advanced trader, this video is for you because the issue of liquidity is essential in trading because it will help you to really know what is happening in the market and where prices are likely to go. So liquidity, as we know, is the lifeblood of the financial market. What is high resistance liquidity? High resistance liquidity refers to zones that have already taken liquidity and are likely to face a strong resistance before price breaks through them. So there are areas that have heavy orders and where price is unlikely that price will struggle to break through them. So what are low resistance liquidity? So low resistance liquidity zones are areas in the price action or areas in the price range that has liquidity in them that has not been taken. So they are normally failure swings. As you can see in this price action here, we see price in an uptrend here. It came to this point. This swing failed to take out this swing here. Then we move in to this area and this created another swing low which failed to take out this one here. So we created another swing and it failed to take out this area. So all this area became our low resistance liquidity to be run. So price normally track to this low resistance liquidity areas, and this is serve as a magnet to price. So whenever you see price come and sweep a level here, maybe retraces, start retracing, it is retracing to take out the low resistance liquidity. So assuming you are in a bigger time frame and you have your possibly fair value gap, order block, equilibrium range, and you are expecting price to pull back to this range and take equilibrium. So on the lower time frame, you have many levels of low resistance liquidity that price will run through. So that is how it is. So this area is our low resistance liquidity. We see price going back to take this level, as this is our protected low. Price swept it and it becomes a major market structure shift. When price retraces back and start creating failure swings, low resistance liquidity to be swept. As you can see, price goes back and take all those levels. Then we see a manipulation here that price will to. This becomes our high resistance liquidity area. So price came down. You can see we have two failures. We have a particular failure swing here that first to take out this low. It becomes an interesting level for price to run through. So price take all these levels and move up. What happened here is that price retraces back, then it created a high to take out this level. As you can see, this high swept this area. This area become our high resistance level area. Then we see price push downwards, creating failure swing. All these failure swing are our low resistance area. So when you take your trend line to plot all these zones, you can easily spot the low resistance area. First of all, you have to understand what structure you are in the market. You have to understand whether you are in an uptrend or you are in a downtrend or you are in a range. When it comes to a range market, you cannot tell because liquidity on both sides of the market. Liquidity is seated on the top or on the bottom. So you have to wait for price to break out of that range, possibly to take liquidity, and make sure you are focusing on the structure of the market to detect where price is likely to head to. So we will take a look at real chart example to see if we can spot our low resistance liquidity areas and high resistance liquidity areas. This is our chart. As you can see, this is kind of price action that is happening here. We can see we have liquidity areas here. Price came, swept this level here, then create this high here, then price came and swept this level as well. Price came and swept to take this level before pushing back. Then we have our major markets. We have a kind of change of character to our major market structure shift here. So in this area has become our high resistance liquidity. So it's very unlikely that price will definitely go back here. Before that, we have a kind of failure swing here. This failure swing is a low resistance liquidity that price can easily be wronged. So if you switch to a lower time frame, you will probably see a long move. This candle here, because we are in a daily chart, this candle here is a long move if we switch to the 1 hour chart. So these areas are the areas of low resistance liquidity. So if we are trading, this should be target. This should be our target. So we have price going through this area, where this range, then pulls back. When price is pulling back, it is creating liquidity. It is engineering liquidity to be run. So when you look at your lower time frame, you will also agree with me that these areas will have many swings and failure swings that will serve as your low resistance liquidity that price will run to. So price came here, put up this level here and closed below it. This before pushing down. This area becomes a high resistance liquidity that price will hardly take. So during this price movement, as you can see, we are in a downtrend. Price is as well creating liquidity here, All these areas here, all these areas are failure swings. They are failure swings. You can see them here. All these area failure swings are liquidity zones that eventually come and take. Price will eventually come and take. But when you are in a downtrend, you can see the structure of the market is down. So we are looking to always sell. We are not looking to buy at the moment. We are looking to always sell. Yeah, so we normally wait for price to pull back to our area of interest, to our equilibrium level, to our OTE. Then from there, we can switch to a lower time frame to take our entry. So always the key to finding your buyers is to know where price is likely to go next. So price is likely to go to these areas of low resistance liquidity here. Assuming you have your price range here, and you are waiting for price to pull back to your range. We have a fair value gap here. Price pulls back to this fair value gap here, and this is our area of interest. This is our area of interest. So we have our premium area here that we can buy. Price pulls back to the premium, so we can take our sell. Price pull back to the premium. We have our fair value gap here. Price mitigate this fair value gap. We switch to a lower time frame, then wait for our inducement or manipulation, which surely occurs here, then before taking our entry. Then when you switch to a lower time frame, during this price move, there is often some retracement. All these retracements are creating liquidity. They are creating liquidity to be run here. So all those liquidity to be run here, all those failure swings are your low resistance liquidity. So when you have those low resistance liquidity here, and you put in a high resistance liquidity here and price failed, it is highly unlikely that price will go back to this level. It is expected that price will take one or two, probably the first two levels of your low resistance liquidity, even if it is going to take this high. So price will always first target your low resistance liquidity before going up. If you can take a new zoom in, you can see at the time price came back around this liquidity, take this liquidity, take this liquidity, take this one. So you can see price come all the way to run most of this liquidity. This is a market maker model. This is how it goes. It's a market maker model. Price always engineer liquidity. As price is engineering liquidity on its way down, it will come back and run all those liquidity. At the time, it will come back and run all those liquidity. So that is what price does. Price is engineering liquidity. As it is engineering liquidity, it will come back and run all those liquidity. So always target your area of low resistance liquidity. Always target all those areas. Always target all those areas. If you are confused on this area, pick up your trend line tool and draw this trend line. And draw the trend line. When you draw the trend line, then you start marking out the swing points. Start marking out the swing points one by one. Start marking them out. Mark them out like that, like that, like that. Mark them out. These areas become your liquidity targets. So whenever you are in a market and possibly you see a kind of pullback, price is pulling back, and you switch to a lower time frame, and you will probably see a lot of liquidity that has been generated. If they are very obvious, what you have to do is wait for price to mitigate your area of interest, then wait for manipulation, wait for further confirmation, then make your entry. There is a higher probability for price to revisit all those areas and take liquidity, because price does not run without grabbing liquidity. It is liquidity that will give price the lifeline, the fuel that it needs to move. So price wouldn't just go without taking liquidity. It will take that liquidity and go. And those liquidity are normally residing on the low resistance liquidity. So thank you so much for watching. Subscribe to my channel for more interesting educational videos on trading.